Well, hi, everyone. Welcome to the Buffett and Beyond Research Friday ETF report, July 17th, 2026. Now, this is as of the close on Thursday. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at the QQQs. And remember, this is as the close of Thursday and not Friday, because Friday is opening up very, very weak. So we're going to see some downward movements today, and I'm talking about Friday. Now, here's what I'm looking at. Even though this short-term indicator up here is in the middle of nowhere land, we have to be careful because of these declining tops. So you see that? So that's a little bit of a giveaway. Look at these declining tops in here. That's a little bit of a giveaway. And we are below the 50-day moving average. 20-day moving average green line just about to cross over the 50-day moving average. Not a good sign. And what are we looking at? This 700 level right in here once again. And boy, oh boy, if we touch that, how many times? But we'll see. It might bounce off. It might not. What's worrying us is the downward volume. These red vertical lines, downward volume is starting to pick up. So we'll see what happens. It's a Friday. People don't want to be long over the weekend. But then again, it's summertime, and a lot of the traders are going to be leaving very, very early if they put any trades in today. Our intermediate term indicator is still pointing down, so we have to be very, very careful. It hasn't made a real attempt to break up and turn around. So maybe today might be the day, but according to this volume, we're just not too sure. So we'll just have to wait and see what happens. And let us see what the ETFs did this past week. The leaders were oil and gas. Yeah, oil started coming back up again because of some ships being fired on in the Straits. And we'll just see how that goes over the weekend. And energy right down here is up 4% for the week. I mean, these are pretty big moves for a week in here. Retail actually came up here and snuck in. Home construction did pretty good. Very, very impressed with this move in home construction. And we talked a lot about, or the analysts on TV talked a lot about healthcare, and because one of the stocks were up, United Health to be exact, was up nicely, but healthcare was still down as an ETF, down a quarter of a point. NASDAQ down 2.4% as of the Thursday close. So look at the ARK Innovation Fund, down almost 6%, and the semiconductor, which is usually leading, is down 11% this past week. Very, very nasty in there. And how about year to date? Well, the semiconductor is still at the top, so it was down last week, up for the year still. Oil and gas not getting there for second place, and energy. Transportation, we talked about transportation last week, and it's up 31%. I think we talked about it in our weekly newsletter, and it is up 31% for the year. So the common sense thinking is that this transportation average should lead the stock market, and then when we look at history, we show that it doesn't. But the thinking is that transportation average is the first average to see, or the first group of stocks to be able to see the increase of orders because of raw materials and finished products being transported from here to there. And therefore, once the transportation picks up, that means the economy's picking up. Well, the economy's doing very well, thank you. It's just the semiconductors and the whole AI industry, they're saying, show me the money, show me the profits. And even though revenues are coming in for AI and Anthropic, the thing is, will they bring those revenues to the bottom line? And that's what we're all waiting to see. And right now, the market is thinking that the technology stocks, let's go back to weekly, that the semiconductors and technology stocks relative to AI are a little bit overpriced, or maybe a lot overpriced. That's what the weekly is telling us. Year to date, we're still caught up in the euphoria of the semiconductors, and the memory stocks specifically, which we'll go over during the week. Again, gold down 8%, so gold is here at the bottom. Technology back up here. I hate to make you dizzy, but technology up here is doing very, very well, and the NASDAQ 100 is still doing very well above the S&P 500, which is sitting at 10% right now. And let's see how our top stocks did, or the top stocks that we have in some of the ETFs. And the XSD, the semiconductor, is up 33.5% for the year. So it's doing very, very well, even though it's below the ETF as of right now. So we'll see how these stocks do during the rest of the year. But being in second place at 33.5% is not bad at all, folks. Technology, yeah, we're really doing well relative to the ETF, up 33.2%. Notice our technology is catching the semiconductor stocks. So that's strange, because usually the semiconductor does better. We compare our growth portfolio to the S&P. S&P is up 10%. We're up 18%, our portfolio, doing very, very nicely in there. Home builders, again, between the home builders here and home construction here, we're looking at home builders up 8%, home construction at 4.4%. Our portfolio is made up of home builders and home construction stocks, because a lot of the home builders are in the home construction ETF, and a lot of the home construction stocks in the ETF of the home construction ETF are in the home builders. So we combine the best of both, so we can get 5 or 6 good stocks. So we're up 13.6%, doing very, very nice, especially when you consider the S&P is up only 10%, and home building and home construction has been lagging the S&P 500 this year. But our top stocks in those industries are up 13.6%, very nice. And then the ARC Innovation down 0.33% for the year, and we compare that to our technology ETF top stocks, 33.2%. Dividend growth and income up a nice 13.3% if you include the dividends. So this is doing very, very nice and above the S&P 500. So we love it. And again, we talk about the dividend growth and income portfolio, and Warren Buffett believes that a certain percentage, depending on your age, should be in some type of dividend growth and income portfolio where you get income of over 3%, and ours is paying 3.7% at the beginning of the year. And you also want stocks in there that are growing, because you want to protect your buying power, because don't forget, in about 18 years, a $500,000 cash pile under your pillow, $500,000 in 18 years will only buy $250,000 worth of goods. Yeah, you get cut right in half after about 18 years. So you need money in some place that grows. We talk about real estate every now and then, not too much, but every one of us probably has some kind of investment in real estate, even if it's the home you're living in, which is pretty much protecting against inflation. So that's what you want, a dividend growth and income portfolio. Now, a growth portfolio that's strictly growth, up 18%, is the portfolio that's going to be the mainstay, even through retirement. But you want some dividend growth and income, because in retirement you need the income. And then you rebalance once a year, as Buffett says, and we've been rebalancing once a year over the past 23 years with this portfolio, which has outperformed the S&P on a compounded basis for 23 years, going on 24, by the way, by almost 3-to-1, and doubling Buffett's returns by 2-to-1 over the past 23 years. And we showed this last year, or last week exactly, over 7.5 years now. We look at the S&P up 201%, which is nice, but the XLK, which is your technology, up 500%, and our model portfolio up 1,300%. So it pays to pick the best stocks out of each ETF over the long term, ETF or index. And we've been doing just that using the clean surplus methodology. So it's not that we're brainiacs sitting around thinking of this, that, and the other thing. We use a methodology. Of course, back in the day, we had to develop that technology into a stock selection model, but now we're using it. And we stick to that model pretty much, folks. And then down here, the semiconductor up 775% versus the Dow or the S&P at 200%. The XSD up 775%. Our top stocks doubling that at 1,500%. But it's not without risk. And we're seeing that this past week. And when you're reading this on Saturday, Friday is not starting off to be a good day. But look at this kind of risk that you have to take to get that. So maybe a small part of your portfolio might be in this, maybe 10% or something like that. I know a lot of money managers like to say, hey, put 10% in a riskier portfolio. But folks, this is the center of everything that we do in the world, between technology up here and between the semiconductor stocks, which are part of technology. So in a time when the market was down only 19%, but that's a lot, down 19%. And don't forget, the NASDAQ was down 34% during this time, and our top stocks were down 42%. So there's risk involved with this type of return. So folks, we had a tumultuous week, and it's ending tumultuously, up and down, up and down. So it's the weekend. Forget about the market, because guess what? It'll be back open on Monday. So forget about the market. Do what you got to do. Go out. Forget about it. Be with your loved ones. Take your mind off the market. Maybe have Sunday dinner with the family. That would be nice. And just stay healthy. Stay safe. We'll see you back here in a couple of days.